Welcome back to Morning Trade Live. I'm Nicole Petalides. Moments away from the opening bell. Want to get you ready for the opening bell today, the big picture, because we have a lot on our minds. Cameron Dawson, Chief Investment Officer, New Edge Wealth, is with me. There is so much going on. It's great to see you, Cameron. Thank you for being here with us. I'll start with, we've seen oil prices moving higher. Now we're above $75. I mean, we're not seeing a spike to 90. However, it's notable, right? Some of your thoughts on the oil action.
Yeah, we do think that oil prices are very, very important for this market, simply because oil has been in a downtrend for the last 3 years, and that has been a very beneficial thing for headline inflation readings. It's been a beneficial thing for the Fed being able to have that immaculate disinflation. And it also has been a beneficial thing for consumers. So if we were to see the trend in oil shift more into an uptrend, and it's a big question if this big price move that we've seen, about 25% off of recent lows, can be sustained. But if it is, and we shift into an uptrend, this could be a big change for a headwind to consumers, potentially causing a rebound in headline inflation and backing the Fed even more into a corner. So remains to be seen if a trend change is happening, but that's what we have to be watching for very closely.
And at this point, we don't know. We know the president was in the Situation Room over the last 24 hours, really mulling over what to do with this situation pertaining to Iran. Do you have any scenarios that you're planning for, or very much in a wait-and-see mode?
I certainly don't want to cosplay as a geopolitical analyst, which is why we keep coming back to the oil technicals, because that is the determinant as to whether or not this is a geopolitical situation that remains contained. Oftentimes, geopolitical situations are contained and they don't have a lasting impact on markets. However, if we do really start to see a trend change in oil prices, so things like a series of higher lows and finding really good support at moving averages, that would be a sign that the market is picking up on the fact that this is not a contained geopolitical event. So we'll bring it back to oil in order to keep it very objective.
Yes, understood. I do want to ask you about your thoughts on the Fed for later today, but what's your big picture on how the market is behaving, and do you think we can break out to new highs at some point?
This market, we think, has been primarily driven by a positioning chase higher. What we saw is that traders got extremely underweight the market. If we go back to the beginning of the year, we were trading we were in the 98th percentile in that Deutsche Bank consolidated positioning report. We got all the way down to the 2nd percentile in those April lows, and now we're just still back at the 28th percentile, which just suggests that there are still some people who are sitting on the sidelines of this market, which brings us back to this notion that the pain trades still could be higher as people are drawn back in. Now, a big thing to watch is that the market now is already trading at 22 times forward earnings. So that is just a half turn below the peak valuation we got to at the end of 2024. That, of course, was an environment of peak optimism, peak American exceptionalism. So a really big question is whether or not this market can break through into new valuation highs, which is necessary in order to get this market back to new all-time highs.
Understood. What do you think the Fed should do in the next 6 months? We have a meeting today, and folks are planning on, I don't know, 1 or 2 cuts this year, maybe in the back half of the year. Does that seem like the plan and a good plan?
So we've been thinking that the Fed would be a lot like O-Town, meaning they would be all or nothing at all, meaning the Fed is either going to cut a lot because you're going to see much weaker economic data, which suggests that they have a lot more cuts to do to get us back to a less restrictive rate, or they will deliver no cuts because the data just simply doesn't support it. We've been thinking that the recalibration phase of this Fed easing cycle is far over, meaning the good news cuts that Waller was talking about are likely not something that the Fed is going to pursue, simply because you don't have enough weakness on the employment side, and there still is a great deal of uncertainty on the inflation side of things. So yes, inflation data has surprised to the downside in recent months, but there's a huge question mark about the path forward for inflation, not just because of tariffs, but now because of geopolitical risks and the price of energy. So that all just means that the Fed is likely to sit on its hands and wait and see and wait for that clarity it talks about. But we think that clarity could take a long time to get here.
So as you look at a portfolio here and you're weighing growth versus value, and of late there's been some risk-off mentality, though for the most part we've really seen some nice action, and we've gotten to the highest levels since the April fall to 4,800 or so. What is your advice to investors now?
So one of the interesting things is that growth versus value has really been about an earnings story, which is that value earnings continue to be cut actually rather aggressively, and growth earnings are holding up, which just means that we are still saying that we want to be balanced between growth versus value in portfolios. But in the value side of things, we're focused on the most high quality portion of that group of stocks, simply because those are the names that have shown the best earnings resiliency in this uncertain kind of environment. So it all comes back to earnings, which is why we stay in the highest quality portions of each of those groups, meaning we're looking for strong free cash flow names, good balance sheets, good return on invested capital, with the goal of being able to deliver that kind of earnings certainty, which is something that is fairly narrow in this market.
When we look at growth versus value, and you're looking obviously for those that can really bring it to the balance sheet and have some more certainty than others, how about the sectors? Are there certain sectors that you lean towards in this environment?
We have seen a lot of resilience out of tech, and I think that that is really notable, is that despite all of the uncertainty going on with tariffs, you've seen a lot of tech earnings resilience. But the reality is that we find opportunity across sectors. So we don't avoid one sector totally and completely. So we're finding opportunity within some defensive sectors, some cyclical sectors as well, and really bringing it back to those quality metrics, which we have found that through cycles have been the best predictor of better returns. And it's not sometimes as exciting as some of the times when we have big junk rallies. We are starting to see some more speculative behavior happen in markets. Look at IPOs doubling. You've seen the IPO index outperform a lot coming out of the April lows. We're not in the business of wanting to chase those kind of junk rallies. So we'll stick to our discipline and stick with quality.
It's great to see you, Cameron Dawson. Thank you so much, Cameron. Thanks. Chief Investment Officer at New Edge Wealth.